Welcome to The Investing Show. I'm Simon Lambert, and we're back with a new series of the show that looks at how you can make more of your money. I'm joined today by Ian Lance, co-manager of Temple Bar Investment Trust, a man who says valuation matters, which is a slightly off-trend idea at the moment, having seen the Magnificent Seven dominate investment returns last year. But last year was also pretty good for Temple Bar, wasn't it, Ian? It means you've been able to profit from shares like Marks & Spencer, which had a fantastic year. We'll come on to that in a minute, but first of all, can you tell us, what's your investment philosophy?
Yeah, well, you've already hinted at it. We're what's known as value investors. We still do genuinely believe that valuation does matter to your future investment returns. So what does that mean? We basically believe that sentiment, fear and greed tend to move share prices around by more than is warranted in the underlying change in the value of the business. And actually, you just mentioned the Magnificent Seven. You think in the last few years some of them went down 50%, up 100%. Did the actual value of those businesses change by that much? No, it didn't. What moved them around was just investor sentiment, wasn't it? And so as a value investor, basically what you're trying to do is look to exploit that overreaction in other investors. So when other investors are fearful and drive the share price of a business down well below what you think is the value of the business, that should be an opportunity for you to sort of step in and try and get a bargain.
And how do you look at the intrinsic value of that business? What is it that defines that for you?
Yeah, so what we do is we basically ask ourselves, where do we think the cash earnings of this business can get back to on a 5-year view? And so we're simply not interested in where our earnings going in the next 6 months or even the next year or so. We're asking ourselves, as and when conditions normalise, what is the earnings power of this business? And then we say to ourselves, what are investors like to value those earnings on? So what multiple are they likely to put those earnings on? And we come up with a sort of rough intrinsic value of that business. And if we can buy something where we think there's kind of roughly 50% or more upside to our view of the intrinsic value, then that's normally a good candidate for the portfolio.
So if you look at one of those companies that you just mentioned, like Facebook, for example, which had a stratospheric fall in its share price.
Yes.
Did you ever look at that and think that might be a value stock now?
That one we didn't, but actually, I'm glad you mentioned that, because the fund management industry has sort of, in the last few years, I think, invented these arbitrary categorizations of quality and value, haven't they? And it's almost sort of never the twain shall meet. And that really annoys us, actually, because we've never viewed the investing in landscape like that at all. And to prove it, we often say to people, do you realise we used to own Microsoft? And most people are sort of almost flabbergasted when we say that. So, you're value guys, don't you just buy rubbishy old dying industries? Well, no, of course we don't. We're more than happy to buy quality businesses like Microsoft. We just don't like overpaying for them. And believe it or not, there was a point about 10 years ago, actually, where consensus was that the Microsoft's business model actually was really under pressure. And believe it or not, you could buy it for a cash-adjusted PE of less than 10 times, and we did. And, there are lots of other examples like that, Relics and Unilever and all these other sort of quality businesses that more than happy to invest in. We just, we're only going to buy them when we think they're cheap.
And with a big company like the ones that you've mentioned, is there a greater margin of safety often when buying them at those lowly valuations than compared to looking for small cap companies that are trading at really low valuations?
Yeah, I think there is. I think our portfolios tend to be skewed sort of large cap and mid cap, and we would be willing to go down the market cap spectrum if we felt we needed to do that for to find the sorts of valuations that we're looking for. But right now, you don't need to. The sorts of valuations that we're seeing in the large cap space is very, very attractive. So you don't need to take the additional risk, I don't think, of investing in a much smaller business, which is, by definition, going to be more risky.
Now, we last had a conversation just over 12 months ago. Well, actually, it was probably about 14 months ago now. And I remember you saying that looking at the UK market, you thought it was as cheap as it was in 2008.
Yeah.
When you look at it now, do you still think the same thing?
Yeah, I do. And actually, we've got charts that sort of show this. The valuation. The UK market trades at about 40% discount to MSCI World. The 50-year average is about 17% discount. So by historic standards, it's very, very cheap. The other thing that I think is quite extraordinary is that actually we've had a pretty decent year, few years in terms of the performance of the trust. And remarkably, the trust has derated over that period of time. So if you went back, about 3 or 4 years ago, the average PE across our funds was of the order of about 11 times. Today, it's 8 times. So our stocks are actually cheaper today than they were a few years ago. So, unlike I hate this term, but the Magnificent Seven, where a lot of their returns have come from the fact that they've just got significantly more expensive, our stocks have actually got cheaper over the last few years.
And there's often talk of the UK market. Well, it is cheap. It's cheap compared to the world, but it's been perennially cheap for quite a long time.
Yeah.
And people are waiting for the catalyst that lifts up the UK market.
Yeah.
Are they looking at it in the wrong way? And instead of looking at the UK market as a whole, they need to be looking at the individual companies within the UK market and going, right, which ones of these are cheap and can have that potential catalyst?
Yeah, I think that's exactly the way they should, because certainly if you're investing in something like Temple Bar, you're buying we probably own about 20 UK stocks because we own some overseas stocks as well. But you're buying, aren't you, a basket of what you think are the cheapest stocks with some of the best prospects. You're not buying the whole index. So I think that's absolutely how you should look at it, is within that universe, can you find yourself a sort of, a decent basket of stocks which trade at very low valuations and have the potential to grow their earnings? And I'm saying today you absolutely can.
So if you take one of those, for example, like Marks and Spencer, very high profile and has done very, very well over the last sort of 12 to 15 months. What was it that initially attracted you to Marks and Spencer, and what was it that made you think there's going to be a catalyst there for it to bounce back?
Yeah, it was. We first got interested in it when there was a management change. So a chap called Archie Norman became the chairman of Marks and Spencer's around about 2017, and he began to identify I think the strategic errors that the company had gone through, what the problems were. So things like that, they were definitely overcosted. They had no significant online presence in a world where most of their competitors had gone online. Lots of the stores were in the wrong places and were pretty unattractive formats. And him and, to their credit, the rest of the management team basically set about addressing those sorts of issues. And actually, if we come back to your initial question about how do we assess intrinsic value of a business, when we looked at their businesses, they've got a food retail business and a clothing and home business, and we asked ourselves, what sort of margins can they make? We thought about 4% for food retail, about sort of 10 or 11 for clothing and home, and that gave us about somewhere between 25p and 30p of earnings per share that we thought on a normalised basis, not immediately, but as and when the business recovered. And so what we saw was a business where it clearly had been underperforming, new management team who were addressing the issues, and for potential for the earnings to start to grow. And I think what's been really nice about the last year or so is that strategy has really started to pay off, because they are a business who throughout the last year they've had a number of positive earnings changes. So where they come to the market and they've beaten expectations, sort of analysts have been increasing their earnings per share estimates. And the market has gone from hating Marks and Spencer's 2 years ago, when people used to say they were absolutely crazy to own that, to actually now quite liking it. But funnily enough, we do still think that they are at the start of this journey, and we still think there's a significant amount that they can do.
Yes, because I was going to ask, with a stock like that, how do you, when it's risen by that much, and you look at those gains?
Yes.
How do you think? Okay, what do we do now? Do we hold on to this?
Yes.
Do we sell it? Do we take some profits?
Yeah.
I mean, for example, the expectations on Marks and Spencer's are now quite high.
Yeah.
Because when they brought out the Christmas trading update, which to all intents and purposes was a great Christmas trading update,
absolutely,
the shares fell that day.
Yeah, they did. Yeah. Because it's the travel and arrive thing, isn't it? I think expectations were very, very high, and you probably now, unfortunately, have some fast money in Marks and Spencer's who are sort of trading the results and things like that. I think I'll say two things. Number one is you have to remember how far the shares fell and how cheap they became in the middle of the pandemic. The share price got to roughly £1, just above £1. And when I say that the earnings, we think the earnings potential is between 25 and 30p. So you're talking about stock on 4 times earnings. So even though that the shares have gone up significantly from then, they were coming off a very, very low base. So that's point number one. Point number two is if you think that the earnings are going to continue growing, and we do, then actually we still think it represents pretty good value. And I think the business now itself has got quite significant operating momentum. In other words, we're beginning to see the fruits of some of those changes begin to come through and really deliver positive operating momentum. So we, despite the fact that it's gone a long way off a very low level, we still do think that's quite a good value in the stock.
And dividends are obviously important for you. It's a dividend-paying trust. Would you class it as an income trust?
We would class it as an income trust, and we think, and the dividend is clearly important to a lot of people who own the shares. The way that Nick and I have always thought about it, though, is that we always look at the dividend at the portfolio level, not at the individual stock level. So we've never been the sort of investors who will say every stock that we buy needs to yield more than the market. And that gives us the flexibility, of course, to buy what you might describe as sort of recovery stocks. So stocks where either because there's been an economic recession or maybe because there's been strategic error or there's been a downturn in the industry, the earnings have gone down, probably the dividend's been cut. Going back to my point about overreaction, investors are basically pricing the business off that low level of earnings. Whereas we're looking 5 years out and saying, no, actually, we think on a 5-year basis, the earnings are going to recover quite significantly. And therefore, it's cheap, on a total return basis, even if at the time it isn't paying you a dividend. So it means that we can have a few of those types of situations within the trust, albeit that the trust itself still yields over 4% today. So.
And one of the biggest holdings, if not the biggest holding, is BP, isn't it? So if you look at an oil giant like that, where the shares have recovered massively since the pandemic, it's already making lots of money. It's already paying a big dividend. What's the thinking behind saying, right, we're going to keep holding that stock and we're going to make it a core part of our portfolio?
Yeah, again, it's because of the, it all comes back to the valuation. So even at most of the oil businesses tend to use around a $70 oil price in their planning assumptions. That's what we use when we value these businesses. And most of them are trading around sort of mid-teens free cash flow yields on that sort of oil price. And today the oil price is actually higher than that. So what does that mean for you as an investor? For you as an investor, it means potentially you've got let's call it a 5% dividend yield. The companies, if they've got a 15% free cash flow yield, they could buy back another 10% of their shares, couldn't they? Now, most of them are probably buying back another 5% or so of their shares. But that means, potential total return for you as an investor as 10% without any growth and without any valuation change. Just simplistically, mathematically, your dividend yield plus your share buybacks gets you to that sort of 10% figure. And in actual fact, not only do we think they're cheap, but we still think the fundamentals of the industry are very good from the point of view of our original thesis was that there's been far too little investment in this area in the last decade. We have just significantly underinvested in this area of the market. And demand has not rolled over at the extent to which I think some people thought. So estimates are for demand for oil this year to be about 102 million barrels of oil a day. That is the all-time high, and most agencies forecast that is going to continue to grow because of growth out in developing markets, out of India, China, and Africa, and so on and so forth. So demand remains strong. Supply is not increasing because the capital expenditure is not picking up, and the shares remain very cheap.
It sounds like this is an investment approach that requires a great deal of patience.
Yeah, it does.
And the ability to sit there and think, it will come, or I will allow the returns to come. Do you think individual investors make the mistake of not being quite that patient, or often not patient enough?
They do, but I don't. I suppose I don't blame them because. Because they're not professional investors. The only thing that I would say is that in some ways, I would say that those people have one advantage over a lot of professional investors, which is that they don't have to worry about their career. So if you buy something and you think that it's cheap and it doesn't work out for the first 6 months or something like that, you're not going to fire yourself, as a retail investor. Lots of professional managers, now not us, but lots of the other big fund management companies do have that worry. They can't afford to take a long-term contrarian view, because if things don't work out for 6 months, 12 months, etc., they got someone tapping them on the shoulder and saying, well, I know somebody else that can run that fund. So it's a shame actually. I think that more people don't use that to their advantage. Actually, the fact that they do really have the ability actually to be quite long-term and contrarian.
there's nobody standing there pointing them and saying, well, the global index did this. And
Exactly
you've
right.
only done that,
Exactly.
which is presumably even more of a problem with the domination of the US stock market. Of the
Yeah,
global index.
totally. I think if you're thinking about how you're investing your own pot, as long as you're making a good return and not taking too much risk, does it really matter that the Magnificent Seven have gone up 50? Of course it doesn't. If you're comfortable with the stocks you own and you think they're making you a good return, you're not taking too much risk, then that's fine, isn't it? As I say, you're not going to fire yourself. So.
Now, one company looking down your holdings that I found very interesting was Stellantis.
Yeah.
This is the car making conglomerate that includes Citroen, Peugeot, Vauxhall, Fiat. I mean,
Jeep, Chrysler.
Yeah, exactly. I mean, why are you holding that? You could have bought Tesla.
Yeah, we could. Yeah.
What's the thinking behind holding Stellantis?
Yeah, unfortunately, it comes back to that boring old thing, valuation again. But actually, Stellantis is I think just an amazing example of the sorts of levels of undervaluation that you can find in the market today, because there are pockets of the market that lots of professional investors just still don't want to get involved in, and one of them is autos. So if I said to you that when we bought Stellantis, we bought it on a price earnings ratio of 3. I don't think Nick and I have ever bought anything on a price earnings ratio of 3. But it actually gets better than that, because Stellantis have got a third of their market cap of cash on the balance sheet. So on what's called an EV/EBIT, enterprise value to basically a cash adjusted PE, is on about 1.5 times. It was on a dividend yield of 9 at the time that we bought it. And I suppose people might say, yeah, but it's a ex-growth industry, isn't it? It's not going to grow. Well, nobody's told the management team that, because they have a strategy to basically double their revenue by 2030. So if they get that right, it's an incredibly cheap company with a fortress balance sheet with plans to continue to grow the business. So I mean, that's, just quite remarkable.
And that push for people to switch to electric cars, obviously it helps companies like Tesla and the more high-profile, flashy electric car makers, but it also presumably helps the legacy car makers who now have consumers with an incentive to trade up to what is ultimately a more expensive car.
Yes,
of course.
Right. Yeah, that's exactly right. That's right. Actually they've got a really nice portfolio of brands, because they clearly have presence in the EV market, and then the luxury end, they own things like Maserati as well. So they have quite a nice portfolio of brands across the whole business.
And if you think about the holdings that you've got, are there any companies that you think stand out as quite interesting ones that you invest in?
Yeah, I think the interesting ones in our portfolio are often the most controversial ones. So I'm going to come up with a controversial one. It's a company which is formerly known as Royal Mail and now known as International Distribution Services. I think the first thing that's probably quite important to say today is that they don't own the post office. I think some people might, having watched the Mr. Bates drama, might think that IDS own the post office. They don't. The government has owned the post office throughout that time. So why is it interesting? It's interesting because there are two very distinct businesses, and I think everyone values it off the UK business, and not just that, they value it off the near-term earnings of the UK business. They own a European and US logistics business, so basically just parcels delivery, called GLS, which is a very good business. We all know the parcel delivery is growing because we're all shopping online, aren't we? That makes a very healthy margin. We reckon that business on its own is probably worth maybe £3.50, £4 a share just on its own. Share price of the entire group today, including that, is about £2.50. So you're already saying that the UK business is in for a sort of a negative value. And maybe the UK business is worth nothing, but worth pointing out that the UK business today has about 10 billion of sales. Now, it's a business which is going through transition from letter delivery to parcel delivery, and clearly, that is going to involve restructuring, and it's not going to happen overnight. But if they do get it right, and they should be able to get it right, because they have a very strong position within the UK market, then again we sort of think that the value of that UK business again could be worth £3, £4, something like that. And so potentially there's very significantly upside. Now, it's worth stressing that this is a very long-term contrarian investment. This is not going to happen overnight. And it's one of these things where one has to look out 5 years and say to yourself, in 5 years' time, if they've got that right, then potentially there's a very profitable business there. So it's, as I say, quite a controversial one, but one where we think there's potential, a lot of upside in the long run.
Ian, thank you very much. That's all we've got time for.
Pleasure. Good to catch up.
And thank you very much for watching The Investing Show. Join us next time. Goodbye.